This video discusses how United States savings bonds, both I bonds and EE bonds, are taxed, how the taxes are reported and calculated, and how to minimize or eliminate those taxes. Bonds are not subject to either state or local taxes. However, bonds may be subject to federal taxes, but there are ways to minimize or even avoid federal taxes. The owner, who may not be the buyer, reports the interest and pays the tax. Taxes can be reported annually or deferred. However, the chosen method must apply to all savings bonds you own, including savings bonds you buy later. If you defer the tax, then taxes will be due when the bond is redeemed or matures. Co-owners must pay any taxes on bond interest that is proportional to the amount of money they contributed to the purchase price. So if a father pays 75% of a savings bond and his daughter pays 25%, then he must pay 75% of the tax and she must pay 25%. Even if she receives the entire proceeds. This rule allows the choice of reporting the interest annually or when the bond is redeemed or matures. If the tax liability depended on who received the proceeds of the bond, then a choice between annual reporting and deferred reporting would not be possible. Accrual method taxpayers, usually a business or other entity, must report the interest each year as it accrues. There is no other option. Most people choose the deferral method since it eliminates annual reporting and defers taxes until the bond is redeemed or matures, which may be years in the future. However, low-income people, especially children, may benefit by reporting the interest annually. Taxes can be saved for children even if the proceeds are not used to pay for educational expenses. By putting the bonds in the child's name only and filing a tax return for the child and electing to report the interest annually, the child's tax rate will apply to the child's income. So if it is less than the standard deduction for children with investment income, then there is no tax. However, if the child receives significant income, then kiddie tax rules may apply. In this case, taxes on the interest may be deferred until the bonds are redeemed, when the interest will be taxed at the child's rate if she is at least 19 years old or 24 years old if she is a full-time student. Redemptions for younger children will be subject to the kiddie tax rules. Later on, I will be discussing how you could save on taxes if the bond proceeds are used to pay for higher education expenses. However, to take advantage of this program, the owner of the bond must be at least 24 years old on the issue date of the bond. This means that any bond owned by children will never qualify for this interest income exclusion. To take advantage of this education savings bonds program, the bond must be owned by a parent or guardian who is claiming the child as a dependent. The choice to report the accrued interest each year can be made either by your child or by you for your child. This choice is made by filing an income tax return that shows all interest earned to date on all U.S. savings bonds owned by your child, and by stating on the return that your child chooses to report the interest each year. Keep a copy of this return. Unless your child is otherwise required to file a tax return for any year after making this choice, your child does not have to file a return only to report the interest. This choice must apply to all savings bonds your child owns, including all future acquisitions. You may change from annual reporting to deferral by asking the IRS for permission, which is granted automatically. Detailed instructions shown here can be found in IRS Publication 550 under the section for U.S. savings bonds. You can also use Form 3115, Application for Change in Accounting Method, to change from annual reporting back to deferral. When the bond is redeemed, matures, or is reissued, then a Form 1099 will be issued to the bond owner, showing all interest earned by the bond up to that time, even if the interest was reported annually. A Form 1099 for bonds held electronically will be issued by the end of January in your Treasury Direct account. You can find detailed instructions in Treasury Direct. Form 1099 will report all interest earned on the bond, so if you previously reported some of the interest, then that interest must be subtracted on Schedule B. If you use tax software, as most people do, you must make sure that the software provides a means of subtracting previously reported interest. Otherwise, you will pay additional tax on that interest. Federal taxes can be avoided or reduced on interest used to pay for qualified educational expenses or for contributions to a Coverdell Education Savings Account or a qualified tuition plan, also called a 529 plan. To receive this tax-free treatment, the following requirements must be satisfied. If a bond is used to pay for your educational expenses or to fund your Coverdell ESA or QTP, then you must be the owner of the bond. To pay for expenses or contributions for your child's education, then you or your spouse or both must own the bond, and the child must be your dependent being claimed on your tax return. Your child may be a beneficiary, but not a co-owner. Qualified expenses must be paid to an eligible educational institution, which is any accredited public, nonprofit, or private college, university, vocational school, or other post-secondary institution. Qualified higher educational expenses include tuition and fees, but not room and board, required for enrollment or attendance. Qualified expenses also include contributions to a 529 plan or a Coverdell Education Savings Account. The expenses must be for you, your spouse, or your dependent. There are also some redemption requirements, the primary requirement being that the educational expenses must be incurred in the same tax year the bonds are redeemed. The tax savings for the educational bond program is limited by income, specifically Modified Adjusted Gross Income, or MAGI. MAGI equals taxable income plus additional income that would otherwise be excluded or deducted when calculating normal tax liability. For instance, IRA deductions would have to be added back to taxable income. The income limits phase out over a range of $15,000 or $30,000 for married couples filing jointly. The phase-out limits are adjusted annually for inflation and apply when the bonds are redeemed, not when they are purchased. This screen shows the formula and an example for calculating the tax-free portions of bond redemptions if MAGI exceeds the phase-out threshold, but is still below the phase-out limit. Simply multiply the redemption amount by the amount your MAGI exceeds the phase-out threshold, divided by the phase-out range, then subtract that from the redemption amount. If the bond proceeds exceed qualified educational expenses, then the percentage of interest that is tax-free equals the percentage of adjusted qualified educational expenses over the total bond redemption amount. Taxable interest equals total interest minus the tax-free interest. Form 8815 must be filed to exclude interest used to pay for qualified higher education expenses or for contributions to a Coverdell Education Savings Account or a 529 plan. You must name each person who is benefiting from the bonds proceeds for their higher education, as well as the names and addresses of the eligible institutions. Note that if the bond proceeds are contributed to a Coverdell ESA or a 529 plan, then you must add that to the name and address of eligible educational institutions in Section 1B of the form, as you can see from the example on the screen. Use the initials QTP to specify a 529 plan. Although you do not have to, you can use Form 8818 to keep records of your bond redemptions used to pay for higher education. Just specify the serial number, issue date, and face value of the bonds. Schedule B of Form 1040 is used to exclude the interest used to pay for higher education by subtracting the excluded interest from the total interest earned. You cannot avoid taxes by holding bonds in an IRA or other retirement account. While there is no legal prohibition on holding U.S. savings bonds in a retirement account, there are practical problems. As non-marketable securities, U.S. savings bonds cannot be transferred from your Treasury Direct account to an IRA. Only cash, not property, can be used for contributions to retirement accounts. Therefore, paper bonds cannot be transferred to retirement accounts. Financial institutions, where most IRAs are held, also do not offer the option, probably because Treasury Direct offers no option that would allow financial institutions to automate setting up a Treasury Direct account for an IRA or other retirement account, so it would not be scalable for a large financial institution to offer this option cheaply. What about a self-directed IRA? Trusts can buy savings bonds, and IRAs are a special type of trust, but the trustee must be willing to set up a Treasury Direct account. However, you cannot serve as the trustee of your IRA, even a self-directed IRA. A self-directed IRA may hold U.S. savings bonds if you can find a trustee who is willing to open a Treasury Direct account and buy them with your contributions. I could not find any self-directed IRAs that offered the option of buying U.S. savings bonds in their marketing materials. Even if it were possible, there are many disadvantages to self-directed IRAs, so for most people, this would not be a good option. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thespanner.com for more than 850 in-depth fundamental tutorials on personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.